Imagine a world where the most powerful financial institution simply doesn't exist. No Federal Reserve, no central bank, no interest rates, inflation targets, or emergency bailouts. Sound impossible? It's not. It's happened before. And today, in 2025, the idea is being whispered again in campaign speeches, policy papers, and conspiracy threads. But let's ask the question seriously. Could the US abolish the Fed? But it's not fully private either. And if it did, what would happen to the world? Welcome to InnerEconomics, where we explore the hidden forces shaping money, power, and behavior. If you enjoy deep dives like this, hit subscribe and join us for new episodes every week. Almost every country on Earth has a central bank. Even the tiniest island nations, Tuvalu, Kiribati, rely on one, or at least lean on Australia's. But there's no economic institution more influential than the US Federal Reserve. It sets the tone for interest rates, inflation, employment, and in times of crisis, keeps the entire global financial system from falling apart. And yet, there are growing calls to shut it down. To some, it's the root of all inequality. To others, a bloated, unaccountable institution. And to conspiracy theorists, a shadowy cabal of unelected elites pulling the strings behind the scenes. But where did the Fed come from in the first place? To understand that, we have to go back to a time when the US had no central bank. And why do we now depend on it? In the early 1800s, America's banking system was chaos. Each region had its own banks, its own notes, and no real standards. You could hand someone a bill in one city, and they'd have no idea if it was real in another. It worked, until it didn't. In 1907, a massive bank panic almost collapsed the system. Only a private bailout led by financier J.P. Morgan stopped a total meltdown. That close call triggered a realization. America needed a central backstop, a lender of last resort. So in 1913, the Federal Reserve System was born. Its original mission was simple: prevent bank runs, stabilize the currency, and provide a foundation for national trade. That foundation would grow into something much larger. Over time, the Fed became a kind of economic pilot, not steering the economy directly, but adjusting the throttle. Its two main tools? Interest rates, the cost of borrowing money, and open market operations, buying or selling assets like government bonds to control how much money flows through the system. If inflation gets too high, raise interest rates. People spend less. Demand cools down, prices fall. If unemployment rises, lower rates, make borrowing cheaper, stimulate investment. Demand rises, jobs follow. It's not a perfect science, but it's more like nudging a giant stubborn elephant. But in theory, it works, until it doesn't. In recent years, the Fed has been under pressure like never before. During COVID, it pumped trillions into the economy to prevent collapse, buying up bonds, stabilizing markets, supporting recovery. But much of that cash didn't go to consumers. It went to the wealthy and into assets like stocks and real estate. The result? The rich got richer, asset prices soared, and inflation started creeping in, hard. To fix that, the Fed raised interest rates. Fast, highest levels in decades. And who did that hurt? Not the wealthy. They don't borrow. It hit the poor. Households with credit card debt, small businesses, renters. The Fed found itself stuck, trying to cool inflation with tools that mostly punished the very people it wasn't trying to target. At the same time, it faced another problem: government spending. The US government was pouring money into the economy at record rates. Tax cuts, military budgets, social programs. In economic terms, that's called expansionary fiscal policy, stepping on the gas. Meanwhile, the Fed was stepping on the brakes. And you can imagine what happens when you do both at once. The result? And a growing belief that maybe the Fed isn't as effective as we thought. So now the idea's back. What if we got rid of the Fed? The US could dissolve the Federal Reserve System, hand control of monetary policy to the Treasury, let elected officials manage interest rates and print money directly. But here's the problem: political cycles. No president wants to raise rates right before an election. No lawmaker wants to tighten spending when voters are demanding help. And that's exactly why central banks are supposed to be independent. They do the unpopular thing for the long-term health of the economy. Countries that mix politics with monetary policy usually end up in trouble. Turkey tried it. The president fired central bankers who raised rates. Inflation soared, The currency collapsed. It didn't end well. So even if the Fed isn't perfect, the alternative might be worse. Still, the Fed itself is under growing scrutiny. Its recent policies inflated asset bubbles. Its tools seem increasingly outdated. And its structure? Strange at best. Did you know the Fed is made up of 12 regional banks, each partly owned by private banks in their region? It's not a government agency, but it's not fully private either. Not because of some lizard people theory, but because it feels like a black box with trillions of dollars inside. So where does that leave us? The Fed isn't going anywhere. Not soon, not realistically, but its challenges are real. Inequality has warped the effects of monetary policy. Government spending is pulling in the opposite direction. And inflation remains difficult to control without hurting the people already struggling the most. Central banking worked when the system was smaller, simpler, and less unequal. But today, maybe it's time to rethink the system itself. Because if we're asking whether the Fed should exist, maybe what we're asking is, who should have the power to control an entire economy? Thanks for watching. If you found this video helpful, hit like, subscribe, and share your thoughts in the comments. We'll see you next time, right here on InnerEconomics.